Hello and welcome back to our Insider Interview series. I'm Dave Baxter and joining me today is Henry Dixon, Lead Manager on the Man Income Fund. Henry, thank you for joining me today.
Thank you for having me.
Performance has been very strong for the Man Income Fund in recent years, but if people are looking at the fund now, what would you think are the biggest opportunities for it and the biggest challenges for performance?
Yeah, absolutely. I think an obvious place to start, particularly with the new inflationary backdrop that we might be currently facing, is a degradation in aggregate demand, concerns around recession, and we've got to be aware that valuations are no longer rock bottom like they were 2 to 3 years ago. So I think we need to be conscious of that. I think opportunities would be, while valuations are no longer rock bottom, they're still low by the context of history, and I think look relatively very attractive versus international benchmarks. So I still think there's plenty of valuation on offer, and that valuation is being corroborated by elevated M&A activity, for example. So I think that's important. And how the aspects could improve, I think, for us would be, if ever this very, very poor flow picture, which has been in the feature of the UK for the last 10 years, if that was ever to normalise and if it ever to get inflows, then I think that really could prove quite a powerful driver for sentiment.
Do you have any thoughts on what could drive inflows? I suppose we've seen some of the performance return.
I think first and foremost, performance has been really important. It's been really good to see this performance being posted by the UK market in both good times and bad. I think it's been very resilient in periods when it's been difficult out there as well. I think that's very heartening to see. I think there's also areas of asset that are under discussion around, uses of pension money. Is it right that they're so underweight their domestic asset class? Also, it's the case that investors who do get a tax break for investing into equities, should it be the case that they just invest overseas with that tax break, or should they be spending more of their money domestically to try and stimulate equity demand? So these are all points of discussion, but all I would say is the signalling from this, I think, could be quite powerful. And that could drive that first change in sentiment. I think it could be quite self-fulfilling when we do see that first inflow come into UK.
So obviously there are many eyes on the economy at the minute. Inflation is back and there's the prospect again of higher interest rates. How do you feel about the UK economy and how do you feel about the UK consumer?
Yeah, absolutely. I think quite a bit to unpack there, and clearly it's a very fluid situation at the moment we have in the Strait of Hormuz. I think I would just make a few points with maybe another point of inflation pain, which was the Ukraine war and what happened there. Is I would say, that before the Ukraine war, inflation in the UK was 5 and rising quite rapidly. I think what we see today is that inflation is 3 and was falling as we were entering what has just happened this year. So I think the inflation backdrop in general is quite different. The other thing to think about is potential rate rises from here. With interest rates at 3.75, you could have 2 rate rises from here, and rates would still be well below where they were for the bulk of 2025 and all of 2024. So I think that's quite important to say. We aren't talking about a new high here in interest rates. I just think, we might be talking in no rate cuts or maybe 1 or 2 interest rate hikes. So I don't think that is a level of interest rates that has unduly unsettled the economy historically over the last 2 to 3 years. And then in general, I'd say the UK economy has done an incredible job of weathering what has been a very difficult decade in general, and I think the bedrocks and the building blocks behind why it has managed to weather that is we've got in aggregate a private sector that looks quite underlevered versus history, and we've also got a very, very strongly capitalised banking sector, which I think has helped us to, as I say, weather what has been some very awkward periods of time, certainly over the last decade.
How much exposure would you say the fund has to the UK consumer? I note that names like Bellway, for example, are in the top 10 list.
Yeah, very much so. So absolutely the case that we really like those asset plays within house building. I'll continue to bang on about it, but where we can find valuations that stack up against the global financial crisis, I think that will be a risk reward that is certainly worth taking. Other areas of retail consumer for us is actually quite thin on the ground. We don't have exposure to food retail, we don't have exposure to general retail. We have in the past, but those are names that have actually done quite well. And I think we clearly have to be conscious of maybe a slightly tougher consumer outlook, because I think one thing we have to be conscious of is that the employment data is just starting to show the first signs of creaking, and I think that for us is definitely driving some sector thoughts at a time when some sectors that are exposed to the consumer have done very well.
So in that context, are there more, defensive areas that you've identified, you've been attracted to?
So I think, you can find a lot of comfort from looking at some of the asset values that are in place in the market and the price that you're being asked to pay for those assets. So I think that gives us a lot. I think some other areas of defensive value that we might see would certainly be within tobacco, for example. So you'll see Imperial Brands, for example, has been a situation that I think has been lowly valued and has behaved exactly as you'd hope from a defensive. And then other areas that I think have also been defensive by nature, but also showing some quite good earnings momentum at this point in time would be the utility sector.
What have you been doing in the recent market volatility?
Oh, absolutely. So we've been quite active. I think it's really important as active managers we use that to our advantages, and I think we must adapt where we see new information. So certainly quite quickly at the outset of the hostilities in the Middle East, we felt we had an opportunity to buy more exposure within the oil sector. Further to good value, I think we just saw the introduction of earnings momentum given the move that we saw in the oil price, and so having done that at the outset, that's actually been really quite well rewarded. I think there's second derivatives to the oil price as well, so you can think in terms of things like the coal price, for example. So that again encourages us to up our weighting within Glencore, for example. And then also looking at the other end of the spectrum, areas of the market that have really fallen, and really sort of tough areas that have fallen under tough times. Some of the domestic opportunities have got even more stark. So I think we've been happy to add to areas that we liked there before that have fallen further, and as I say, the valuations start to stack up against some previous crises on a very, very attractive basis indeed.
Yeah, and speaking of domestic names, I mean, this might be a slightly simple way to view it, but I imagine some viewers will be interested in the fund's kind of exposure to areas like the FTSE 250 and mid and small caps. Are there any specific names there that have been standing out?
Yeah, so I think names that I think stand out against sort of long run averages. So I'll give you two. So I mentioned real estate, for example. I might single out something like Derwent London, which trades at about a 50% discount to asset value. That's a price that you can only find at points of real acute discomfort in the market. So I'm talking about COVID and the GFC. I think other areas that I would mention as we moved out of maybe large cap financials into mid cap financials is we moved into something called TP ICAP, which is a interdealer broker, but the valuation is very undemanding at 7 to 8 times earnings with net cash on balance sheet. And so that's been an opportunity that I think we've been able to harvest profits out of banks that have done very well into this that has really lagged behind.
And how do you feel about the performance gap we've seen between large caps and small and mid caps in the UK? Do you see any catalysts for that gap to actually narrow?
Yeah, so I think the best lead indicator that we would have for future outperformance would be valuation, particularly if it's backed up by cash flow. And I think we have to be very honest that this astonishing run that the large caps have been on over the last 3 years, and I think we've been able to harness it in certain places quite well within the fund, did come from the bedrock of very modest valuation. Vast swathes of the FTSE 100 trading on 6, 7 times earnings 3 years ago, and that was actually the discount to the valuation that you were being on offer within mid cap and small caps. I think now looking at the situation today, I think that's changed quite a bit, and I think it is the case that some of the best value opportunities reside within mid-cap and small cap. And so that's absolutely where we've been trying to tilt the portfolio in the last 6 to 9 months. And as I mentioned, I really do believe that the best lead indicator I can give you is where these most attractive valuations sit, and they are increasingly down the market cap spectrum.
So where have you focused in the small and mid-cap space?
So exposures within the fund to that would be certainly overweight mid and small cap now. That was in slight contrast 3 years ago where we found ourselves almost equal weighted with the large cap arena, which puts you at sort of 75 to 80% of the fund in that area. But given the price differential and the valuation differentials, we think it's right that we increase our exposure to these mid and small size areas of the fund now.
Yeah. And finally, our usual question, do you have skin in the game?
Absolutely, personally, and also other family members are invested in the fund.
Henry, many thanks for your time.
Thank you.
And thank you everyone for watching. We hope you enjoyed the video. Do let us know what you think in the comments. And as always, if you're enjoying this series, hit the like button and hit the subscribe button. Take care.